Hey guys, what's up? How's it going? Robin here. Welcome back for another video on the channel. In today's video, I'm going to be showing you guys all my Canadian dividend stocks inside my Wealthsimple trade account, give you guys an update on how the portfolio is doing, and inside this video, I'm going to be doing a deep dive, analyzing each stock one by one, and sharing with you guys my thoughts on the stock, as well as talking about some things that have been happening in the market as of lately. So like usual, if you guys enjoyed this video, please remember to give it a big thumbs up, and remember to subscribe to the channel if you guys want to join me on my investing journey, and if you guys want more Canadian-based investing content. Alright, let's hop inside my portfolio and let's see how my Canadian dividend-based stocks and Wealthsimple trade are doing as of today. Alright guys, so the first thing we're going to be talking about is my dividend-based portfolio. We'll go over my dividend stocks really quickly, and I'll show you guys how those guys are doing. I'll give you guys an update on my REIT stocks that I've recently sold, and I'll talk about the dividend income from this portfolio, and I'm going to talk about my goals kind of later on in the video, so that'll be towards the end of the video. But the first thing I want to show you guys is basically my dividend stocks. We'll go through them one by one, and I'll give you guys like my thoughts and opinions on them. So first of all, here's a portfolio we have inside of our TFSA on Wealthsimple Trade. We have $12,614 as of right now. Our personal account, we recently just sold all our REIT stocks, so as you guys can see, the account is currently empty, and we have to wait. I think it's like 1 to 3 business days before this money can be accessed. That's just the way Wealthsimple Trade works. They do have like a delay, so we're gonna have to wait till probably Monday or Tuesday, and then we'll have to take this money out, withdraw it, and then put it back inside our TFSA. But as you guys can see, our REIT stocks were up about 19% all time when we sold them. And if you guys want, you can watch some previous videos where I went through the REIT portfolio. Actually, I talked about it in my last video, so check out the last video if you guys want to see how my REIT stocks have been performing. But here's our TFSA, which is mostly based on the Canadian dividend stocks, and we are currently up 11% all time. So over the past couple days, our stocks have been pretty good. We're up 1% in the past day. As you guys can see, it's Sunday right now at the time we're recording this video, so of course we're not buying any stocks today. I'll probably do a video either tomorrow or the next day where I talk about some Canadian stocks that I'm buying, so stay tuned for that. But we're up $66, which is 1%. Over the past week, we are up 2%, so pretty good in the past week. In the past month, we were up 12%, which once again has really been really good for the Canadian stock market and the stock market in general. Over the past 3 months, we're up 11%, and then all time, like I just showed you guys, we're up 11%. So our TFSA is doing pretty good, all things considered. And here's the individual stocks that we have. So once again, mostly Canadian-based stocks. And going into the future, I do want to add more US-based stocks inside my TFSA, and I'm going to be focusing on US-based growth stocks. And I'll talk about this later on towards the end of the video, but I have basically $16,000 in contribution room coming in the new year of 2021. So the main goal for 2021 will be the same thing as this year, which will just be maxing out my TFSA with Canadian stocks and a little bit of US growth stocks. That's my goals. And I'll talk about that more as we go through towards the new year and whatnot, and some different funds I've been looking at. I'm currently just trying to figure out what's the best way to do this, and I have a few ETFs lined up. And once again, I'll talk about that more going towards the end of the video. But here's the stocks inside my portfolio. So the first stock is Algonquin Power and Utilities Corp. This is a utility corp or power corp based out of Canada. I'm buying this for the long run. It hasn't had a really good year. I bought it towards the end of the year, and as you guys can see, it is up 8%. So we missed the jump up, and most of that's coming from this period of time right here. And I've kind of bought it towards the end here. This is a good long-term based utilities corporation, and I'm basically buying this for the long-term growth because they have good stock appreciation with good dividend increases. So that's an important thing. Next up we have is Enbridge. Now Enbridge is an interesting company because, I mentioned before that they're a company that just hasn't really done that great in the past couple of years. Their stock price is down. It hasn't been really good. Now they do have a really big dividend yield, seen in 8%. But the problem is I just haven't seen good stock appreciation from this company. So I do own this stock, Enbridge, and an ETF that I'm going to talk about later on called VDY. So I have a little bit of in there, so I'm probably not going to buy any more individual shares because I don't know. Enbridge, I want to see more stock growth from the company. Now they might grow and kind of rebound a little bit, so there's potential for that, but I just don't see it happening, especially with like their earnings and whatnot. Like it's just like, to me, it's kind of like, well, it might happen, it might not. So their dividend yield is nice right now, but I think going long term, I don't know if Enbridge is a company that's really going to get as much growth, such as Algonquin Power Utilities or even Fortis that we have here as well. I think like Fortis to Algonquin, even though they have lower dividend yields, I think they're the companies that maybe in the long run might perform the best because they'll get that stock appreciation with that dividend growth, because their dividend yields are a lot more conservative, so they're more likely to actually increase them. So if you buy that stock now, that dividend yield will increase going into the future. So I think that's probably the smarter buy, and that's why I'm kind of steering away from Emerge. And once again, I have a lot of it in an ETF VDY, so I'm not too worried about that. Next up we have is H&R REIT. Now I was up about 20% in H&R REIT in my REIT portfolio. Once again, check out the last video if you guys want to see that. But I was up 20% because I bought it right in the beginning of March, and H&R REIT took a big hit at the beginning of this year. As you guys can see, it's down quite a bit, just like RioCan. Now, I think right now, at the time of this video, I still think RioCan and H&R REIT, after RioCan's dividend cut, I still think it's a good buy because of the fact that these companies are still severely undervalued, down 30%, 32% over the past year. I still think it's worth buying. Even though the dividend yields are like that 4 to 5% range, they're still pretty solid. Like, that's still a good dividend yield for a company that has a lot of growth to kind of recover from, and I think they will. So going in the future, I'm still going to be buying H&R REIT and RioCan. Those are probably going to be the main REITs I'm going to be buying. But I'm not going to be buying as many REITs as I have been in the past, but I'm still going to be buying them because I still think that there's tons of room for growth. So obviously I just started buying a few shares of H&R REIT in my TFSA over the past couple weeks, so that return is obviously down here, but realistically we were sitting at like a 20% return. Next up we have is Manulife, and Manulife is a big company for me, and I've been investing in them a lot over this year because they're still down quite a bit, and they did get a nice little recovery over the past couple months, about a month or two. Nice recovery here. They're still down 8%, so I still think they have a lot of growth, and they do have a decent dividend yield. So it's also like that nice good opportunity to buy the stock right now to get some good appreciation maybe over the next year or so, but also get a good dividend yield locked in. So that 5%, I think it's a 5% dividend yield they have right now, plus potential to earn that 8% growth and even more growth going into next year maybe. We should see some good returns, and I'm currently sitting at about plus 16.59% with Manulife. So that's worked out pretty good for me, and I'm pretty happy with that investment. And for the time being, I'm still going to invest in Manulife. Obviously, as the share price goes up, I might not invest in them as much because, I don't think it's as good as a buy as the share price goes up, but I'm still going to be buying them for now. I still think it's still undervalued and it's still worth buying. Next up, we have RioCan, and I kind of just briefly touched up upon RioCan. Still down 36% year over year. Now, they did cut their dividend, as a lot of you guys know. It's been the news for the past couple days, and a lot of people are freaking out. But in the end, I still think it's fine. I'm not buying RioCan for the dividend yield. I mean, yes, that 8% dividend yield was awesome, but I got a lot of dividend yield throughout the year already, and I still think it's 4 or 5% dividend yield that it's going to switch to in January. It's still decent. Like, for a stock that's down 36%, that's most likely to grow, I'll take a 5% yield, because let's say if over the next 3 years, let's say it takes 3 years for RioCan to recover, let's say it takes 3 years for it to recover, and it gets 10% per year plus the 5% dividend yield, that's 15% rate, per year, and it might even recover like over the next year completely, in which you get a crazy return. So it just depends, right? But the longer it kind of takes, the better it is in a sense, as long as we're seeing that recovery. So I still think as long as it's this low, I still think RioCan is a good buy. I wouldn't go super crazy with it, but I'm still going to be buying it on a regular basis. And like I said, I did sell most of my recent shares to move them into my TFSA. So these shares I've bought recently, obviously, so they're not down, they're not high as much as they were before. So just kind of, once again, watch the previous video and you guys will see what I mean. Next up we have is RNW, TransAlta Renewables. Been a really good company for me. A nice a monthly dividend yield company. As you guys have guessed, it's a renewable source of like power-based company. Really good company that's kind of new. And they're doing really well. And over the past year, they're up 16%. So they've had good recovery. Once again, they dipped like most companies did at the beginning of the year, and then just had a good recovery. And, they're a really good stock. I think they're going to do really well going into the future. And I'm going to keep buying these on a regular basis. Like, I still think I'm not going to go crazy with them, but I'm going to kind of slowly just kind of make a little bit of my portfolio RNW as time goes on. And once again, up 19.72%, so that's a nice good yield with a nice monthly dividend yield. Next up we have is Severia Corp. Currently kind of not doing so best. I guess a lot of healthcare companies are down quite a bit. They had a nice good jump earlier this year, but they're kind of on a declining path, and this is kind of expected. A lot of people jumped on these healthcare stocks because everybody was like, okay, you know what, we need to pay more attention to our healthcare. But that kind of fizzles out, and then these stocks kind of, a lot of them, in my opinion, were overpriced. Like, they jumped up too much. and this is why I didn't go crazy with them. Like I bought a couple, but I didn't go super crazy. So we have 8 shares of Severia Corp, and we were up quite a bit at the beginning of the year, but now we're down at negative 1.91%. So this is a good reason why you don't buy stocks kind of based on your feeling or just on like very, very limited information, because like, you want to go for consistency. You want to go for companies that are constantly growing. And yes, Severia Corp might, do well, and it has been doing okay, but over the past 5 years, like the history of this company, like yes, we've seen tremendous growth rate here, but it is kind of on its way down a little bit. So, interesting point to make. We'll just have to keep an eye on it, but I'm not going to go super crazy because I really don't know what's going to happen with it. Next up, we have Shaw Communications, pretty common company when it comes to telecom company in Canada. Over the past 5 years, they haven't been doing so great. They have a high dividend yield, but once again, you know what? They kind of fall in that trap of that high dividend yield company that just has not seen any growth. We look at like Enbridge, Shaw Communications, another one of those companies that just isn't seeing that stock growth. The dividend yield is nice, but if the company's just going down, you're just losing money, right? So, I bought a couple shares. This was actually the first stock I bought inside this portfolio. If you guys watched the first video I did, sometime in January for this portfolio, this was the first stock I bought, and I'm probably not going to be buying any more shares of Shaw because I just don't think going in the future they're going to do well. I think there's so many better telecommunication companies like TELUS, for example, which is the next company that's just going to do so much better. Like TELUS, and as you guys can see, over the past 5 years, TELUS is up 21% with a good dividend yield. They have a good dividend yield as well. So just in my opinion, the safer, better company to buy, and we're currently up 7%. I just started buying TELUS not too long ago, but as you guys can see, we're up 7%. So even TELUS is growing in this market, and Shaw Communications is not. So, I think for telecom companies like TELUS or Rogers are definitely the better buys. Moving down in the portfolio, we have my favorite bank stock, TD, and TD is probably a bank stock I'm going to be buying forever. They have the highest earnings, the highest growth out of all the banks. I was looking at a graph and I couldn't find one in today's video, otherwise I would have showed you guys. But they are in terms of earnings and growth, they are the biggest Canadian bank stock. They are growing the most. And as you guys can see, over the past 5 years, they're up 30% with a nice dividend yield as well. TD has a great dividend yield, and they got hit hard by the pandemic, but once again, bank stocks will recover. I currently own about 15 shares of TD, which is about $1,000, and we're up 10.91%, which is $100. So I'm definitely going to be buying more of TD, and I think the stock is just going to keep growing. I think when it comes to buying individual companies, like dividend-based companies that have good stock appreciation plus a good dividend yield and dividend growth, also important, TD is one of those companies. Like hands down is one of the best companies for dividend investors. If you're a Canadian dividend investor, all the bank stocks are pretty solid for the most part, but TD I think is the best one. Going down here, we have VDY, which is the main ETF inside this portfolio. And if you guys know anything about me, I value ETF investing. I think buying the market overall is the best play for long-term growth and just for like your mental health and stuff like that. I think as an investor, it's just one of the best ways to invest. And I've been buying VDY, which is a Vanguard-based Canadian high dividend yield index, and I'm going to talk about Vanguard a little bit later on in the video and why I like it so much. VDY specifically, but you guys can see over the past year, VDY is still down 3%, so there's still tons of growth. But this represents a good chunk of the Canadian market, and a lot of the companies I talked about already are already in VDY. I understand that. But I'm buying VDY just to get a little bit more exposure just in case kind of thing. So we have 72 shares of VDY, total value about $2,412. It's about 31% of my portfolio. Over time, I might make this a little bit more. We'll wait and see. We're up 10%. And as you guys can see, I think it's just such a good fund. It's just so many good companies, and it has good stock appreciation with good dividend yields as well. And going down towards the bottom here of our portfolio, we have some old ETFs that I bought in the past and I'm no longer really buying, but I'm just keeping to eventually kind of sell once things go up. We have VYM, which is an international ETF I'm not holding anymore. I kind of bought this and decided pretty quickly this wasn't a good ETF to buy. I'm going to be selling this once things go up a little bit. We have XHD, which is a Canadian hedged US index. Once again, bought a good chunk of this, but I don't think it's a really good ETF to hold long term. I think maybe like a Vanguard fund like VYV, which I'm going to be talking about later on as well, is probably a better growth-based US stock fund to hold. So once these ones go up, I'm going to be selling them. Same with XRE. I don't think I'm going to be buying XRE because I'm just going to buy the individual REITs and not have to pay the fee Same with ZWC, although it's performed well, I just don't have no interest in holding it because I'm going to like buy VDY with a little bit of TD, and I think that's going to be good enough for me. So I just wanted to give you guys an update on the dividend portfolio for that sake. So that's my plan. So let's jump over into some ETFs. I'm going to talk about some ETFs and some future plans for the portfolio as we go into 2021. Alright, so I've talked a lot about VDY on this channel, but I'm still going to just talk about it because I still think it's a really good fund for dividend investors, especially for Canadian stocks. And the biggest thing I like about it is, number one, the fee is pretty cheap. 0.22% fee. For Vanguard is a little bit higher, but in terms of overall ETF market, this is pretty cheap. Most ETFs charge at least like 0.3 or 0.4 or 0.5 or even more. Like there's some that charge way more than that. So this 0.22% management fee is super cheap. So I really like that. But if we go over the returns for VDY, there's one important thing I want to talk about, and this is going to lead into talking about the US growth-based stocks, is that the one thing we like about VDY is not only does it have like good dividend yields, like as you guys can see here in this income return by NAV, this is talking about the income return by the ETF. This is the dividend yield. So this is the percentage you're getting from the dividend yield. So as you guys can see, the dividend yield is nice, like 3% per year on average, 4%. With some 5% here and there. So you're getting about a 3 to 4% yield, which is pretty nice. But look at the capital appreciation here. So 2019, we had 15, almost 16% in capital appreciation from our dividend stocks. So this is why I think chasing high yield dividend stocks isn't the best answer. You're just losing so much on growth if you don't chase companies that have room for stock appreciation. So once again, you can see here that the stock appreciation is quite a bit. In 2017, 4%, 5%. 2016, 22%, 4% in 2014, and then 17% in 2013. So as you guys can see, stock appreciation is a big part of dividend stocks if you buy the right stocks. And then we can see the total return here on the right side. So 21%, 8%, 26, 8%. So you can see together they add up to do a lot. And as you guys can see, if we go down to year, we can actually see like, since inception, you can actually see like the growth of the portfolio over time. So quite a good growth, and I think VDY is one of the best funds for Canadian-based dividend investors. And last but not least, I want to touch upon this really quickly because I think this is worth mentioning as well. One of the funds I'm looking in the future for US-based growth stocks, and you guys can mention them if you want in the comments section, is VFE. So VFE is the S&P 500 index, and one thing to point out really quickly is it's got pretty much a non-existent fee. It's got a 0.09 fee, so that's even better than VDY, so super cheap fee. But look at the returns of some of these US growth stocks, and this is the reason why I want to add them into my TFSA going into 2021. You can see the total return from these funds are absolutely crazy. You can see 24%, 3%, 13%, 8%, 20%, 23%, 40%. So absolutely crazy gains in the US market. And this is why a lot of people say like holding US funds inside of TFSA is a good move to make. And remember, you're only taxed on the dividend growth. So if you buy high growth US funds, right, we can see the dividend distributions here in this column. You're only getting taxed on 2% of the return. You're only getting taxed on 1% of the, well, it's not even the full amount. It's 15% of that 2%, right? So you're getting taxed on very little amounts, but if you're going to make 22% in terms of growth, getting taxed on 15% of the 2% is like whatever. It doesn't matter in the end. So this is why I'm thinking about adding some of the, like a fund like this inside my TFSA so that we can kind of balance the dividend investing and also get some growth-based investing. So let me know what you guys think about that, or if you guys have any ideas for some US-based gross ETFs to add into the portfolio. But I'm definitely looking at VFE, and I think it's looking like a pretty good fund for me. And last but not least, guys, we'll talk about the dividends earned from this portfolio. And as you guys can see, I like to do these updates every couple of videos whenever I have some new information to pull out for you guys. So we finished up November with $41 in dividend growth. And December, a few dividend stocks are just kind of starting to roll in. We made $7 in total. It might be a little bit less because I didn't realize that I sold some of my REIT stocks, but I think I sold them after the declared dividend date. So those dividends should still come in. And in total, the portfolio has made us $222. So as you guys can see, in the beginning, it wasn't that much money, but it's starting to add up. And all this money is being reinvested to grow more. And it's just helping that portfolio compound and grow. So I think adding some growth-based stocks alongside the dividend stocks should really help the growth. And one other cool thing we're going to do before we end this video is let's take a peek at the stock appreciation and let's compare it to the dividend growth from our dividend investing portfolio. So I got my calculator up here and I did a little bit of math here, guys. And one thing you can look at when you're doing dividend stocks is that, yes, the dividends are really nice to see and it is cool to see, but a big part of dividend investing, like I keep saying throughout this video, is stock appreciation. It's super important. You want to invest in the companies that not only will grow their dividends and have decent dividend yields, but also companies that have good stock appreciation, because at the end of the year, it really does add up. So if I took my entire dividend based portfolio and I take the gains, now keep in mind stock appreciation goes up and down all the time, so this is why I don't like to measure it all the time. But if you want to make yourself feel good about your stocks and see more of a return, what you can do is take your dividend growth. So we're up $1,540. As you guys can see, that number is kind of tiny here, but that's how much we're up inside our dividend portfolio. So if we divide that number by the how many months we've been investing, which is 11 months, it'll be 12 months at the end of this year. We've only built this portfolio in January 2020, so we've been building it for 11 months. We divide that total stock appreciation return by 11, we have $140. So on top of this dividends we've earned here, this portfolio has essentially made us, as of today, $140 per month. So that's quite a big difference, and it's actually more than the dividend income. So once again, I want to just point that out, that stock appreciation is super important, and in the end, it kind of will grow more than your dividends. But keep in mind, your dividends reinvested will help grow that stock appreciation, so they kind of work together, and the dividends just are nice, they're just nice to have, right? It helps grow things long term, and it just feels good about having that money coming in. So I just wanted to point that out really quickly, and I hope that kind of helps some of you guys who might feel that your dividend income isn't growing fast enough. Also keep in mind that stock appreciation makes a big difference at the end of the day. Alright guys, so that's it for this video. Hope you guys enjoyed it. Let me know what you guys think in the comments. If you guys enjoyed this video, please give it a big thumbs up, and remember to subscribe to the channel if you guys want more Canadian based content and you guys want to follow alongside with me as I do this dividend portfolio. I'll link to my last video, which is my REIT video. I talked about why I'm selling my REITs in that video. Check it out. It has nothing to do with the fact that I think REITs are bad. It's just because I'm moving the money from a personal account into a TFSA. So check that video out. I'll put a link to an end screen somewhere in this video you guys can watch if you guys want. But other than that, guys, hope you guys enjoyed the video. Let me know what you think in the comments, and I'll see you guys later.